Welcome to the 2025 Economic Preparation and Depression channel. I'm your host, Tony. Thank you for joining me on this Sunday edition of the podcast. It's going to be a brief Sunday edition here. We're just going to be talking about the Dow Jones stock market on Friday, as well as the rise in AI and the rise in debt that's corresponding to both of those in this economy. Our thoughts and prayers are with all of the victims in Philadelphia and D.C. with the latest in the air plane crashes. Our prayers are with their families and the people who are coming and trying to figure out more what happened. This country we made it through January. Unfortunately, January was a pretty rough month, not just in the markets and not just in life in general. It's been rough all around. Worldwide for a lot of different people, and especially here in the U.S. So thoughts and prayers are with them. I just want to say that. Now, moving on, we are talking about this Dow Jones economy here, and you can see the Dow Jones closed 300 points lower on Friday, as the White House says tariffs will start on Saturday. So tariffs have started here for U.S. For Canada and Mexico here, and the Dow Jones reacted a little bit by closing 300 points lower on Friday. But these tariffs are going to be retaliatory because it's apparently today, as of Sunday, Canada and Mexico plan to impose their own penalties for the United States in terms of imports and exports. So will this be the next trade war of the West here? Versus we generally worried about China and countries like that, but now we may have a trade war coming here in the West. Let me know what you think in the comments. Is that going to be something that's going to be sparked by these aggressive tariffs that are made against our trading partners? And will this destroy NAFTA, the North American Free Trade Agreement that Bill Clinton started way back in the early 90s, that started this whole thing? But in either case, whether or not the tariffs go away or they stay, cheap prices are not here. Are not going to be coming back anytime soon in terms of groceries, utilities, transportation costs, and small businesses costs in terms of running a business and paying debts. There's never going to be a time where we're going to go back to that cheap money thing that we had back in the early 2000s and before 2008 crash, and even before that. So that's gone for now, because we're not in a normal economy. But anyway, shares are sliding, and also this was also boosted by the rate cut that did not happen. The rate cut did not happen by the Federal Reserve Bank last Wednesday, and so because of which people are saying that there may only be one rate cut, and that may come in the summer sometime, either the June meeting or the August meeting, something like that, for that one rate cut. And even if they do cut rates, it's only going to be about 25 basis points or less here. So consumers might be shocked. American consumer spenders might be shocked. Quote, U.S. businesses prepare for the impact of Trump tariffs here. So this is from the Detroit News press here. They're saying that 25% on Canadian goods and 10% on 25% on Canadian and Mexican goods and 10% on Chinese goods will take effect on Tuesday. That's this coming Tuesday here, February the 4th. And so as these rates come in here, consumers are going to be surprised, because that means prices are going to go up on these goods and services that are coming from these countries. Remember, we import about 70 to 80% of our products, sometimes local, like I said, from Canada, Mexico, sometimes, coming from overseas, of course, China and all these other countries, Belize and Brazil and things like that. So we're going to be feeling some of the price hikes here, on food, insurances, building materials, possibly, that be coming through the rails, some of our leading rails. So we're going to be feeling a lot of these pain here. They're going to be feeling the pain too, though, because even though they're going to be enacting retaliatory measures, they're going to be feeling the pain. Canada and Mexico and China are going to be feeling the pain too. Just as China's economy was growing, they're going to be feeling the pain as well. So that's something to look at. It's vice versa. It's not just a one-way street. Remember, we're in a globalism economy right now, and of course that's changing with everybody going into protectionism and isolationism. But we're still in a global economy. So what affects one is going to affect the other. So AI, in talks to raise funding that will, quote, value the AI startup at over $340 billion. So now they're raising capital. They're trying to compete with DeepSeek, I think it is, the Chinese AI tool that's made available. This is the future. We're moving into this Internet 3.0, ladies and gentlemen, where it's Internet of Things. It's all connected in this kind of wireless web, suspended in the cloud, suspended in the air, and this is what's going to be the next race here. Like we had kind of like how we had the Cold War in the 70s or 60s, something like that. This is going to be the next race here, the AI war, which is going to be, SoftBank is a big contributor. They contributed $15 to $25 billion of the roughly $40 billion being invested. So we need to watch this space here. And once again, like I said, OpenAI faces growing competition in the growth in the artificial intelligence market, including from China's DeepSeek, I should say. So you can see here they're investing a lot of money in this AI infrastructure. The plan calls for billions of dollars to be invested in AI infrastructure, and you ask where the money is coming from. Obviously, from private venture funds, these private capital funds, and also it's going to be coming from a tax-based raise that they're going to be doing probably with a lot of these cities, because remember, Mr. Elon Musk is in charge. He's in charge of the Doge. And so they're going to be raising the taxes and cutting back the fat in a lot of these government departments. And this is going to cause a lot of issues here and going forward in the next 2 years here. So we'll have to see how it plays out. Because look, this is the chart here. This is from Visual Capitalist. Who owns the U.S. debt? As you can see, the Federal Reserve System owns 15% of the U.S. debt. That's 26 trillion of it is domestic. International only owns 7.9 trillion of our debt. So you look at it, you can see the disbursement here for a total of 34.4 trillion dollars of debt right now as we're heading into February. Basically, almost 35 trillion dollars of debt. And so the U.S. dollar is circulated so many dollars out there, so it's not going to be so much whether the U.S. dollar holds up. The problem is that there's too many U.S. dollars chasing too few goods. That's going to be the problem for the westernized nations here, and that leads to a loss in purchasing power. So it's not that the dollar is going to go away; it's that the loss in purchasing power is going to render it virtually useless in some cases. Okay, in terms of buying what you need. Now, maybe it may take 1 year or 5 years, who knows, or it could be overnight. But that's what we're going towards, and I think you understand that too, ladies and gentlemen, here, because you can see, look how much debt that we hold here, and that we're getting away. So international countries hold only 15% of our debt. Japan holds 3%. China holds 2%. Okay, China actually holds the least amount of debt out of the international countries of our U.S. dollars. Who's holding U.S. dollars? Okay, so you look at it's held mostly domestically here. We have $26.4 trillion domestic debt, homeland right here, and most of that's owned by the Federal Reserve System, because when they print a dollar, you owe a dollar. That's our debt-based system economy that we work in here. You owe $2, excuse me. So for every $1 that you print, you owe $2 back to the Treasury or this Federal Reserve System. So mutual funds, once again, in debt. Derivatives, all that's here. State and local governments, they only own 5%. Pension funds, 3%. So you can see here. So intergovernmental debt that the U.S. government owes to its own agencies, that's at 20%. That's a big chunk. So I mean, that's why I think a lot of these agencies are going to consolidate or go away completely. Some of these government agencies, because they owe 20% of the debt. $7 trillion is owed between the agencies, other agencies that the U.S. government has here. So this is what's going to be very interesting. And it's setting up for that oligarchy or whatever you want to call it, or socialism, or oligarchy, or some kind of hybrid automation economy, technocratic economy, because this is why I see it. We're strangling in debt, and we don't have the money to carry on everyday activities like we did in the past 50 to 100 years. So let me know in the comments, what do you think is going to happen? Do you think that there's going to be a rate cut before the summertime? Do you think that this economy is going to be put back on track by our current administration in 1 year, 4 or 3 years? Or is it not going to be on track, and they're just going to kind of be treading water and hoping that things work out as they go along? Let me know what you think in the comments. God bless. I'll talk to you very soon. Enjoy your weekend. Thank you for listening. Take care.